When we think about saving money, the first thing that comes to mind is putting aside a fixed amount from our income on a monthly basis. However, is saving alone enough to become financially secure in the long term? In this video, we'll tell you why most entrepreneurs and businessmen think saving can keep you poor. Keep watching this video because the answer might surprise you. Why saving can keep you poor? Saving money is a great way to start building wealth, but it's important to diversify your assets and start investing. The sooner you start investing, the more time your investments have to grow. With compound interest and investing, your money can grow much quicker than it would with savings alone. The sooner you start investing, the sooner you can start growing your wealth. So if you're just saving money, you're collecting your fixed wealth. But as soon as you start investing, you begin to expand your wealth exponentially. Investing, a smarter way to save. If you're watching this video, it's safe to assume that you want to secure your future and have a financially secure retirement. In order to achieve this, you need to start investing your money instead of locking it away in a savings account. Investing involves taking some risk in order to get a higher return than what you would get from a savings account. However, there are plenty of low-risk investment options that can be a great choice for beginners who are just starting to invest their money. If you are trying to save money, you want to make sure that you have enough money to cover all of your expenses. On the other hand, if you're trying to invest, you want to make sure that you have enough money to buy your first house or last your entire retirement. What's the difference between saving and investing? When you save money, you are putting money away for a specific purpose, such as purchasing a car, paying for college, saving for emergencies, or buying a house. Generally, we save money in a savings account or by setting up an emergency fund in a savings account. The rate of return for these accounts is usually less than the rate of inflation. On the other hand, when you invest in something, the goal is to make a profit and increase your assets. Most people think of stocks and bonds when they hear the word investments. These investments have higher risks, but they also have higher potential for growth than savings accounts, CDs, and money in a checking account. Why you should not rely on saving alone. Saving money is one of the most important things you can do as a responsible adult. However, saving alone is not enough if your goal is to become financially secure in the long term. When you save money, you're putting aside a fixed amount. It's the money that you have already earned. This means if you have less money to save, you will have less money when you need it. On the other hand, when you invest, the goal is to end up getting more than what you had in the beginning. Investing involves putting money into an investment, such as stocks, bonds, or real estate, for the purpose of growing your money over time. You can choose to invest in real estate when you have a larger sum of money to invest. This can be helpful because it could allow you to earn and invest more money over time. You can also choose to invest smaller amounts whenever you have extra cash that you want to put towards something else. This way, you'll be able to build up more and more money as time goes on. So by just saving, you have fixed wealth, but by investing your savings, you are increasing the horizon to which your wealth can grow. Just a quick reminder before we move on and continue our discussion, if you've enjoyed the video so far, consider subscribing as we frequently upload such informative and educational videos. Now let's continue. How much should you invest? If you decide to start investing your money, the next question is how much should you invest? The best way to determine how much you should invest is to use the rule of thumb. The previous advice was to invest 10% of your income, but in recent years, that has been increased to 20% of your income. However, if you can afford it, you should invest more. The other general advice given suggests you invest in low-cost diversified index funds. Index funds are mutual funds that track the performance of a particular financial index, such as the S&P 500. Index funds have very low fees and are a great way to get started with investing. Choose your investments wisely. The most important thing when investing is to choose your investments wisely. There are several different types of investment vehicles that can be used to accumulate assets over time. Each one has its own advantages and disadvantages, so it's important to choose the right one for your situation. Some examples include stocks, bonds, mutual funds, and ETFs. There are also different ways to invest money. For example, some people prefer investing in real estate or buying businesses, while others prefer to put their money into high-yield investment programs like P2P lending or crowdfunding. It all depends on what type of goals you have in mind and what kind of risk tolerance you have. While it's not easy to time the market, it is possible to earn a profit from the market over the long term by investing in companies that have good prospects for growth. Let's say that you want to invest in Google. Before investing, you should make sure that Google is a good investment choice for you. First, you need to look at Google's financials. You can do this by reading Google's 10K report, which is a comprehensive report filed annually by any publicly traded company that summarizes its financial performance. Then, you need to decide if Google is worth the investment. There are many companies that are worth investing in, but only you can determine which one works for you and your risk tolerance. The reason why most people don't invest. Some of the most common reasons why people don't invest include not knowing what an investment is, not knowing where to start, and being scared of losing money. All of these are understandable reasons why people don't invest. There are also many misconceptions about investing that prevent people from putting their money, especially in the stock market. These misconceptions can greatly reduce your financial security over the long term. The biggest misconception is that investing is very risky. It is true that investing can be risky. Still, you can minimize your risk by choosing index funds and investing in companies that have been around for many years. Another misconception is that you cannot start investing early. The truth is that you can start investing early and you should start as soon as possible. It's never too early to start investing. We hope you learned something new today and know why you need to start investing to increase your wealth. Do you invest your money? What do you think is the safest way of investing? Share your plans with us in the comments down below. If you enjoyed this video, give it a big thumbs up and share it with your friends. Thank you for watching.